Today's video I am going to show you a systematic approach. With that you can find out that which are the stocks you should add in this correction, which are the stocks of your portfolio from where you should be exiting, and what is the profit based valuation system on which you can rely on and you can work for entire stock market journey for the rest of your life. So I am taking references from the book One Up on the Wall Street by Peter Lynch, a must read book. And with this I will try to show you and explain you in the simplest way possible that how you can use the profit growth of any company to decide whether to stay or exit from that stock. And also you can choose what are the stocks in current market. I will show you one screener and how to make that screener, which will show you the stocks which are currently available at undervalued based on profit growth model. So we'll start by this. So you may be having many number of stocks, and with this market correction you may be sitting on a loss. So you may be considering whether to stay or whether to exit. There is no clear cut answer, but based on profit growth model we have a PEG ratio. PEG ratio is nothing but P ratio divided by EPS growth. So if PEG ratio is less than 1, it is assumed that the stock is undervalued. Now with that example we'll learn that what is the exactly meaning of PEG ratio. So I will take an example of Mazgan Dock Limited to show you how you can check your stock's PEG ratio, and then you can decide. So Mazgan Dock, you see currently it is available at 2119 and it has already fallen from a high of 2930. So in last 52 weeks high of 2930 was made by these stocks, and currently stock is available at 2119. So it is almost 30% discount it is available. But whether that is really a discount or it can fall more or it is a time to buy, so that what I use is that profit growth. So you have to see the stock P. Stock P is 31. You can see this data freely in screener.in. Now you have to go in profit and loss statement. So when you go down in screener.in, here one small table is there, compounded profit growth. Here you can see last 3-year profit was 47%. This is the number for this stock. Last 3-year profit growth was 47%. Means this company has increased its profit with 47% of CAGR in last 3 years. And trailing 12 months means last 12 months where we are sitting now, from here last 12 months company has shown a profit growth of 72%. So with PEG ratio, this book says your P ratio should be less than or equal to 72. If it is so, your stock is a bargain. So we'll see how much is the stock P ratio. Just now we saw that stock is available at a P of 31, which is much lesser than the number of 72. So it is in a bargain as per this book. This is just for your example, your understanding. Profit is growing by 72% in the last trailing 12 months. So the P ratio should be 72 or lesser than 72. Then it is called in a bargain as per PEG ratio model. PEG ratio should be less than 1. So here P ratio divided by EPS growth. Bottom EPS growth is 72. This number is 70. One second, I will check again. In Mazgaon Dock 72. So 72 you have to write in the bottom, 72, and in the top currently it is available at around 32. So if here it is 72, the PEG ratio would have been 1. Now you can see PEG ratio is less than 1. This PEG ratio is lesser than 1. PEG ratio equal to this, and this is coming less than 1. Because this ratio is less than 1. So you can say that stock is undervalued. Such type of stock you can hold in your portfolio, and also you can add at such prices. If you see the chart of Mazgan Dock Limited also, you will see that stock is consolidating in a flag type of pattern. It has not fallen. Weak stocks tendency is when market will fall like this, they will also fall with the market or more than market. These are the weak stocks. This is the tendency of weaker stock. That is the relative strength model. But strong stocks will not fall as much as market. They will be sideways. here market was going up and suddenly market is falling, the weaker stocks will fall with the market, same or more than market. But the stronger stocks, what they will do, they will be sideways, they will consolidate, they will make a base pattern like a rectangular pattern or a symmetrical triangle pattern or a flag pattern. This is the quality of good stocks. So if the stock in the weekly time frame, this is a weekly time frame, you see that stock is consolidating on lower volumes, volumes are decreasing, volume should be decreasing and stock should have some consolidation, and the peg ratio should be less than 1. If these criteria are met, you can keep your stock, you can stay in your stock, you should not sell your stock. And if you get some such quality, good quality stock, you should add in this market correction. Now I will show you some example where profit growth was decreasing and what happened to that stock. Here in Mazgaon Dock Limited, what we saw, that yearly and quarterly both profit you can see. These are the yearly number. Yearly number you see March 21, 22, 23, 24 and TTM means trailing 12 months. The profit was 514 crores rupees in 2021. Next year 600 crore, next year 1100 crore, next year 1900 crore, and this year 2700 crore. Means profit is increasing. This is the reason stock has gained a lot. And because of market correction, when FIIs are selling, all stocks will go down. It is no matter you are making profit or not, but the companies which are making profit, first of all, they should make profit. They should not be in loss. I will prefer the company which is in profit only. It should not be in loss. Then the profit should be increasing. Here you can see that profits are increasing. And third thing is the growth rate, like whatever in Mazgaon Dock case 72% is there. Currently the PE ratio should be lesser than the growth rate. And in charts, in technical charts, the stock should be making some base. It should not be falling apart. So these criteria are meeting, then I will like to be in the stock and I will add that stocks. Okay, now next example I will show you the Tata Motor example. What happened to Tata Motor? Why it is falling? So you can see the net profit in share market. As per my view, only this simple philosophy works, that if a company is doing some business, it should make some profit and the profit should be increasing. If profit growth will decrease, that company's share prices will collapse. If it is in bull market, they may not collapse, they may be going up with a slow momentum because of the speculation. But if it is bear market, then the market will punish that stock like anything. That happened to Tata Motor. You can see quarterly results. Here up to here that profits were increasing. In 17,000 crore company earned in March 24. Okay, like from there onwards you can see that profits are decreasing. Profit growth has not came. Profits are decreasing. So this is the reason, if you see in annual chart also, we'll try to see here. You see that profit growth has stagnated. Here the profit growth was from minus 11,000. Profit has come 2,600 and then it has increased to 30,000. Now it is stagnant, like profits have stagnant. This happens with cyclical companies which runs in cycles of economy, boom bust cycles, recession, and when again automobile sector demand will come, again profit will increase. So when profits are decreasing, share prices will collapse. You can see if you go to that chart of Tata Motor, we can easily see that the from this July 2024, this after that profits have stagnant, the stock was consolidating and from there it is falling. So this happens when you are giving some profit growth, then stock prices will go to rocket. Then suddenly your profits are stagnant or it is decreasing, that time stock market will punish you. The third case is Trent, which runs Judio and Westlife. If you see trends and data, it has made a high of 8,300. Suppose somebody bought at that high level, 8,300, and now the stock is almost 40% down. It is 5,000. Such corrections, why it came in such a good stock? Because the profit growths are decreased. If you go to profit and loss statement, now you see the P ratio is 121. 121 P ratio is there now also. This is after correction. Before correction, it may be around 180 or 200. But now also stock P is 121. So as per our model, where the PEG ratio should be less than 1, the growth rate should be at least 120%. At least 120% growth rate should be there. Now if you go to profit and loss, you will see the growth rate is 83%. Here you see last 3 year profit growth is 101%, and last 12 months, trailing 12 months, 83% profit growth was there. You can imagine when the stock was at 8,000, the P ratio would have been 180, and you are doing profit growth with 83%. So the P ratio has to come down. There, that is the reason your stock is corrected from 8,000 to 5,000. Now you see here that if you see the data, if you want to see the data, you can see in year wise, and also with the this one. This is I think quarterly result, March 2000. This is the yearly result. March, from here to here, profit increased from 35 to 400 almost, then 400 to 1400. The jump you see 400 to 1400, almost like 4 times. Here also you see 40 to 400, 10 times, and then 400 to 1900. So this decrease in profit growth, any decrease in profit growth will call a correction in the stock price. So if you have any share which is like Vodafone Idea, where the profit growths are negative 12% in last 3 years, and trailing 12 months only 9% profit growth is there. So that type of stock you should avoid, because that type of stocks may fall anytime, and it will not be sideways. It will not become sideways like your Mazgaon dock. What it will do is it will simply fall like this. Vodafone Idea graph you see, it will simply fall like this. Where it has started, the same price it will come. So people who have bought at 17, 18, 16, their money has become half. And now you don't know whether it will go again or not. It is not like every stock will gain its earlier value when market will reverse. No, the stocks which are having profit growth only will gain their previous value, and they will go much higher. But the stocks or companies where earning growth was not there, they will not regain their value. They will be like Vodafone Idea and Yes Bank. They will be lying at the bottom side only. So never do this mistake of keeping your stock in hope that it will reverse. My Karan Arjun will come back. No, they will never come back. That happens only in movie. The book says that you should always invest in a company which is showing profit growth, because this is stock market, and you are here for a for company which is earning. If your company is not earning, then you cannot stay in for long time. You have to exit that stock, otherwise you don't know how much it will fall. That also I have told you how much it can fall. You see how much is your stocks, your company's profit growth, and what is the P ratio. Suppose your stocks profit growth is 20%. Your stocks annual profit, TTM profit growth you have to see. TTM, trailing 12 months profit growth you have to see. Now you find out that 12% is my stocks or companies earning growth. Now I am saying you PEG ratio should be less than or equal to 1. So your maximum P ratio should be 20. Then only 20 divided by 20 you will get 1. If your stock P ratio is currently 30 and your stock is profit growth is 20, then your PEG ratio comes at 1.5. So if bear market continues, your stock will correct more. If suddenly bull market comes from here, that will be a speculative, prices will start coming. That time it may not correct, because 1.5 also is a good PEG ratio. But many of your stock you will find out that PEG ratio is 6, 12, 14, 15, and PEG ratio is negative. Means what? Your company is not generating profit, it is in negative. Now I told it is less than 1 means it should be above 0. It should not, like it should not be below 0. It should be above 0, because below 0 it is showing that profit growth is not there. Profit growth is negative. If profit growth is negative, PEG ratio will be negative. Okay, so don't keep any stock where profit growth is more than 2, 2.5, 3, such high peg ratio market can correct, and your profit growth is decreasing. Suppose any company you find out where profit growths are decreasing, like I shown you Tata Motor example, Trent example. Trent is a very big example. You cannot imagine that Trent people have bought at 6,000, 7,000, 8,000. 8,000 people have bought and now it is 5,000. If that profit growth will not come na, in this stock, this may correct further. Any company, any such good company where profit, Asian Paint, you can see profit growth was not there, so stock has been beaten. Any good amount of reputation will not help in stock market. If profit growths are not coming, then the stock will be corrected like anything. So today's video you can learn two things: how to analyze your stock, whether to keep it or exit it based on profit growth. And second thing is, if you want to add a new stock, what are the conditions to be fulfilled by the stock, and how you can know that your stock, whatever you are going to buy, is in bargain, सस्ते में मिल रहा है. How you can know? Profit growth should be there. Like Mazgaon Dock, profit growth is 72%, and the P ratio currently is lesser than 72. It is 31, half of that. So that time I can say that this is in bargain. So such things we will add in a screener. We will make one screener and we'll see what are the stocks, which are the stocks which are currently fulfilling that that conditions, and from that screener you can see that which are the stocks you have to accumulate in this correction. So for that I will go to screener.in, and I have made a screener which is from Peter Lynch book, that is One Up on the Wall Street. And peg ratio, name I have given peg ratio. This link I will give below this video. So these are the stocks, almost around 200 stocks are there. And what are the conditions? First is peg ratio should be less than 1. Peg ratio should be less than 1. Now if any company you will find out where peg ratio is negative, simply avoid that, because peg ratio negative means profit growths are not coming, they are decreasing. Second is return on equity should be more than 15%. For any efficient company, ROE should be around 15 or more than 15%. Then P ratio also I have added less than 20, so that we will get to know some bargain. And last is ROC should be more than 20, so that again we will get some high quality stocks. If you want to see more number of stocks, you can just delete this line from the screener and you can run the screener, you will get all those stocks. Okay. If you want to get some market cap, then you can write here that market cap. Here you have to write and here you have to write and then like this market capitalization you can write what. Suppose you want to do large caps, then you can write market cap more than 10,000. If you want to get the companies which are small cap, you can write market cap less than 5,000. That companies you will get. So this was the full video. Hope you enjoyed it and learned something new. So based on that you can decide. This is not a recommendation video. Disclaimer is that I am not giving any buy or sell recommendation. I tried to explain you in most simple way how you can see your company profit growths are coming or not. In stock market, what I feel is only this simple logic works, that profit growth should be there. If profit growth is not there, your company will be beaten like anything in bear market corrects all stocks, but the stocks where profit growth is not there are corrected the most, and they never jump back. They will just go like this and they will never come back. But stocks where profit growth is there, they will make a sideways pattern. That is called relative strength. The stock is relatively stronger than the Nifty or Bank Nifty. And when the market will start coming up again, these are the stocks which will become leader and it will gain a lot. So you have to accumulate these stocks in market correction. This is the opportunity. That famous saying is there, na, if a stock is corrected from 100 to 10, that is a 90% fall. But when it regain from 10 to 100, it is 900% profit. But which stocks will regain their 10 to 100 journey? Only the stocks where profit growth was there. If you buy any bad company where profit growth is not there, why businesses are run? for the profit, and profit should be increasing. It is not like your nearby grocery store which has to just the same amount of profit he has to earn for his life. He has to earn, he has to scale. Shark Tank you are seeing now daily. What is the scalability? What are the chances of profit increase? Then only they will invest. You also invest like that only, with that mentality. No matter how much time it takes to find out such good company, you should be patiently wait. And it is not like these stocks cannot correct further. If I am showing you this Mazgaon dog that it is in bargain, it is not like it cannot correct. It may correct 10-20%, but then also you know that these are the companies which are showing profit growth, and this will recover and gain much higher in the future upcoming nifty uptrend rally. With that belief only, you have to put your money with courage. You should not be courageous in any type of company where profit growth is not coming. I will be in hope, I will tell, okay, every stock will come down from 100 to 10, and now 10 to 100 it has to go. Why I will worry? I will keep on money, I will keep on averaging, I will keep the stock. No, your stock will not come up. All stocks will come up. Your friends, your relatives, that Instagram influencer, YouTubers, everybody will tell that their stock has again gained, but you will be sitting like, oh, my stock is correcting more than Nifty. My stock is gaining less than Nifty. Your stock is relatively weaker than Nifty. Try to understand this. Instagram and YouTube are the worst place to learn, because everybody is trying to, everybody, I'm telling you really, I'm working in last 6 months from Instagram and YouTube. Most of the people are telling lies that many stocks are just told to you because they are funded by somebody. And here you can see that 4 names. I will show you that many people will comment that I am this Mazgaon doc has given me money to tell you the numbers. Otherwise, Tata Motor is also good, Trent is also good, Vodafone is also good. So people who don't want to learn and who don't want to accept the reality will tell anything. But the reality is that these are the basics which are mentioned in books. And I know 99% of you will not read a single share market book in your life, because you want a stock recommendation. I'm telling you, you need a stock recommendation. I should come and tell you that these are the stocks you buy. If I'll try to explain you how this works, I made one simple video of Tata Motor, how these cyclical stocks are traded. Cyclical stocks trading is a different regime from all. Cyclical means which runs with the cycles. This is the book where I learned that. And people are trolling like anything, like you are telling peg ratio should be less, now you are telling that P ratio should be high for Tata Motor, then only you should buy. Because P ratio should be high for Tata Motor type of stock when you have to buy. You can go and see, this is not me. You see the P ratio was 110 in June 23, the time where the time was to buy. And when the time was to sell, that P ratio was around 10 here. P ratio was 10. This is the magic of share market. For each stock, each sector, separate things works. The person who is trying to teach you has been mocked, has been given bullshits in comments, and just I'm just thinking whether I did the right thing to start a channel, and whatever books I read, and I thought that I will give this knowledge to people because they are busy in their work, and I have a time and luxury to read these books and gain this knowledge, so I should share this. What I'm getting with this, I don't know. Am I asking some money to people that okay, I'm selling a course and you buy this? Just some people don't want to accept the reality that the stocks which are they holding in their portfolio are going down, and if somebody tells them, shows them mirror that this stock can take your all capital, they will simply switch off that noise, that okay, we don't want to listen this, because that always hurts. This is the reality. So, but if somebody genuinely listen and accept this fact that okay, the stock is going, Rakesh Jhunjhunwala ji once said that I also make mistakes, but I make a mistake which I can survive, which I can live another day. So they will cut their losses because they know that now profit is not coming. They will cut their losses, but we will stick to it. We will just stay in that stock for very long, and it will become a pani pani ho gayi. So you have to be very careful. I'm telling you, if you want to learn, this is the best platform, I guarantee you. I am showing you the mirror of stock market, that this is the thing works. You have to see the profit growth. If profit growth is not coming, you have to exit. If profit growth is coming, you have to buy at good value. The value, good value, I shown you how to check with the peg ratio. And when you buy that, until unless profit growth is coming, you have to stay in that stock. This is the only thing works. And relative strength model also I have explained in my video very clearly and very thoroughly, that how you can use relative strength model, RS model, from trading view. That also you can see the video and you can use it. This will help you and you will make money. This is not a rocket science. This is just a stock market, simple thing. But simple thing also people don't want to do. If it is a complex formula, they will feel that this will work. But very simple thing, a business is there. A Marwadi guy doing a small grocery shop business has to increase its profit. And how much amount I will pay for that stock? If he is increasing its profit more than the whatever he is asking, the multiples of the profit currently, that is P ratio. The simple logic you follow, you will gain. I am telling you. And hope you like the video. If I have told anything wrong, I am sorry for that. And we'll see you in next video. Bye bye.